What's up, guys? Jay Martin here, investor and CEO of Cambridge House, and my guest today is Sean Fieler, the president and CIO of Equinox Partners. At Equinox, they are long-term value contrarian investors, exactly the kind of people that I love to sit down with and pick their brain. Those are definitely the opportunities that I hunt in the market, those long-term contrarian bets. Now at Equinox, Sean oversees the management of $600 million in assets under management. Now around 450 of that is dedicated towards the mining and precious metal space. So today's a bit of a crash course in valuing junior gold companies. And I really drilled Sean on how he dismisses the no's, those companies that he sees. I mean, this guy looks at hundreds of deals. So how does he easily dismiss the companies and opportunities that are just not worth his time, the easy no's? And we get into that, looking for governance issues, jurisdiction risk, all of this stuff. The balance of the $600 million is dedicated towards the energy, the oil and gas sector. So we got into what he looks for in that space. In general, fascinating conversation. We covered a ton of ground. I hope you enjoyed this conversation as much as I did. Now, 3 things before we jump into it. Number 1, if you want to hear more from me, you can subscribe to my newsletter. It's a pinned comment right beneath this video. It's easy and free to do so, and I love writing it. Number 2, this YouTube channel now generates a significant amount of advertising revenue, which is rad. And so what I've decided to do with that cash is donate it to an organization that's super close to my heart called Zero Ceiling. Zero Ceiling's mission is to end youth homelessness. And the way they do this is by giving at-risk urban youth the opportunity to relocate to beautiful wilderness locations, providing them with supportive housing, employment training, and just general great influences on their life. The natural world can be incredibly therapeutic, and this is the gift they give, and I love them for it. So check them out if you're interested. Number 3, if you prefer to listen to my content instead of watch it, you can now find me wherever you listen to your podcast. Just search for The Jay Martin Show. All right, here is Sean Fieler, president and CIO of Equinox Partners. Enjoy.
I assemble the smartest people I can think of or reach out to carry that conversation, and that's exactly what I've done today. Please give my panel a round of applause. Welcome.
Okay, guys, Jay Martin here, investor and CEO of Cambridge House, and I'm joined right now by Sean Fieler, the president and chief investment officer of Equinox Partners. Sean, how are you?
Good, Jay. Good to see you.
Yeah, thanks for making the time. Thanks for coming on. I'm excited to jump into a web of directions here with you. And a good place to start would be for any of my audience who's not familiar with Equinox Partners. Could you give us just the super high level overview, Sean, of what Equinox is and how you spend your time?
Okay, so we're better business value investors. 90% of our time is spent doing company-specific analysis, engaging with C-suites, with boards, getting to know the companies we're invested in really well. Our typical holding period is 5 years. We try for 10 years. And for the last 20 years, a big fraction of our assets have been invested in gold and silver mining.
And when you say a big fraction, let me know if I have these numbers right. There's about 600 million in assets under management, 500 of which are allocated towards mining and precious metals. Is that close?
450, yeah, so close. So it's right now, it's a good majority of what we do. That varies some over time. But given what we're seeing in the sector now, and we do have some dedicated gold and silver mining accounts, so that's how you get to that, good majority of what we're doing right now is gold and silver mining focused.
So what are you seeing in the sector now?
Despair, pessimism, undervaluation, irrational valuation. Big companies using $1,200 to gold to do budgeting. Distributing capital, repairing their balance sheets, and talking up copper or anything other than what they're actually in the business to do, produce gold, just because it's been such a brutal year. So the GDXJ is down 20+% this year. S&P's up, high teens. Commodity index is up 30%. So it's the perfect environment for gold and silver mining, and it just hasn't worked.
Yeah, that's curious, isn't it? It was funny. I was chatting with a few friends who were at the few shows in Colorado in September, Beaver Creek, Denver Gold, and all this. And they said very similar things. I couldn't make it down this year, but they said sentiment was at this shocking low because, if you look at the macro setup, it's quite favorable, you would think, towards gold market, but the market's not performing as maybe historic gold investors think it should or whatever. But what do you point to, Sean? As you said, it's been a tough year, but why do you think it's been such a challenge for gold miners to raise interest from investors?
Well, I would have thought, just in an effort to be very honest, that given that the combination of fiscal and monetary policy that we've had over the last year and a half, that gold and gold mining stocks would have done much better. So I certainly didn't see this coming. I certainly didn't see these kind of declines out of last summer coming. Where not only is gold down, but the stocks are down. Now it's 20% year to date, but compounding that with the highs from last summer, you're down almost by a third, off the peaks from last summer in a lot of the equities. So why? I think basically it's this. We're in the seductive phase of inflation, where inflation seems like it's not that bad. It seems like it's going to help us with growth. It doesn't really seem like currency debasement yet, but I think that's pretty clearly the path we're on. And the farther we get down that path and the more impotent central banks look, the better gold looks. And it's just, it's taken longer than I would have thought for markets and the gold market in particular to discount that future.
Right. Yeah, it's funny. I see all the same things you're seeing. And honestly, Sean, it's just made me more and more excited about my gold portfolio. And, it's not a great looking portfolio right now. I'm down on probably 90% of my gold positions. And maybe this is just like maturity myself as an investor over my investor journey. But for the first time in my memory, I'm super excited to be averaging down in a handful of what I consider to be great names, management teams I love, balance sheets that are cleaner or healthier than they've been that I've seen before. And this decline on the market just adds to my excitement, because it's really hard right now to find any asset class that's undervalued, right? So if you're trying to allocate capital somewhere and you want to avoid anything inflated, I find it quite tough to discover anything. But what do you think about that, other than precious metal stocks?
Yeah, so oil and gas, has now had a good run. I'd say the extreme of pessimism in that sector was maybe even worse than it was in the gold sector at the lows going back a year. And you still have, that's a very, you have a lot of ways in which that investment has been politicized that creates a lot of inefficiency. Similar to what you see in gold. I think it's, today, I think it's a little more balanced than what you see in gold and silver mining. But it's certainly one of the few spaces, gold and silver mining, where you can find companies with great balance sheets, good assets, aligned managements, aligned directors, where you're going to generate not just a 10% free cash flow yield, but in the case of a number of the juniors, you can really find 20+% free cash flow yield at $1,800 gold. And that's kind of, that's shocking. It's not asking you to invest around higher gold prices. It's not asking you to invest around people that have dodgy backgrounds. It's just nobody cares. And that's the opportunity. That's the same reason why I think I'm excited like you are to invest in the space at this point.
So then, therefore, at Equinox right now, are you guys in like full-blown hunting mode? Are you aggressively looking for opportunities? Where are you guys at?
Yeah, I think, really what we've been doing for the year to date has been adding in some of the juniors. So we bought a number of the seniors earlier this year for the first time. Really, in my career, some of the seniors were trading at meaningful discounts to NAV. They still are, not all of them, but a number of them. They have, by definition, a number of world-class assets. Now, some of the seniors have real dividend yields, and then you have a lot of liquidity. You have diversification. You have a lot of benefits in the seniors that you don't have in the juniors. Some of those companies have held up better year to date. And some of the juniors, you've just seen the pricing has been much more uneven. And so the market's just not responding to better news. It's not responding to assets coming on time, on budget in the way that you would expect. And so I see more pockets of opportunity in the junior space, and particularly in the junior producers. And that's really where we've been doing most of the work, and we've been adding recently.
Got it. Okay. Now, do you think there's more distractions right now than there used to be for money allocation? Historically, a traditional gold investor, if looking for hedges against inflation, they have a few options, but there's more today. If you look at assets like maybe just cryptocurrency as a major draw on people's attention and therefore their wallets. Do you factor that into your analysis of why gold might not be getting the lift that otherwise you'd expect in this environment?
I think it's certainly a factor, right? I think most investors see gold as a hedge, but gold is maybe not the only hedge, and gold certainly is the hedge that hasn't worked. And so, even though it's worked historically, given that it's not working now, and I think more importantly, given that they're still making 15, 20% on the S&P, why exactly are those allocators going to be moving money? And I think that's the big distinction between, say, now and what you saw in the 70s, right? You don't have stocks going sideways for a decade. Instead, you have stocks compounding at, mid to high teens every year. So there's just not the impetus for people, even if they agree with us theoretically in terms of the opportunity to actually make the shift. And so I think that's been a bigger factor than the distraction. I think if you think about it, bigger picture, this is a $14 trillion asset class if you're talking about gold. This is not just owned by central banks, but central banks have been the largest consistent buyers over the last decade of gold. So this is not an asset class that's going away. And if you look at the statements that central banks have been putting out around with their asset purchases, it kind of corroborates everything that we know to be true about gold. So it's not an asset that is, I think, in any way being diminished in terms of its monetary character over time. But, I just think people have the sense of urgency and needing to be there right now.
Sure. Yeah, it's not an exciting asset class for the last 12 months. That's for sure. Okay, now diving into about 450 million of the assets at Equinox are allocated towards precious metals or mining stocks. You touched on how you've been buying some majors more recently. Can you get into the breakdown of this for me a little bit? How you allocate between majors, developers, explorers, if you touch explorers, et cetera?
So the vast majority of our portfolio is going to be in juniors and in producers. So that's really where we're seeing the opportunity to find, the free cash flow yields we want with the big discounts to NAV. With the good balance sheets, because very few of them actually have much, if any, in the way of debt. And you can really, it's not so much a theory about an asset, you can actually see the economics of the asset play out in the financial statements of the particular companies. We have a low teens percentage in seniors, kind of across our portfolio. Most of that is in Endeavor, which trades at a discount to NAV, where you have a very well-aligned major shareholder in Naguib Suarez, who's encouraged management in the company more generally, I think, to allocate capital very aggressively and prudently in this bear market. So they consummated really two fantastic acquisitions last year when most of their peers were paralyzed at attractive valuations that were geographically contiguous to their existing operations. And unlike a lot of the other seniors, they're able to add ounces at an average cost of $25, whereas some of their peers are paying more than $200 an ounce. And so the economics are just much better for Endeavor, not just as a free cash flow generator, but as a free cash flow generator that can grow over time. So that's kind of where most of that bucket of that low teens percentage in million plus ounce producers is. And then we'll have less than a quarter of the portfolio that will be in pre-revenue assets. Either those are development plays where they're in construction, something like a MAG or an Orezone would be two examples of companies that are pre-revenue that we've owned in recent years that I think are on track to bring assets on time, on budget, which has been a real benefit to being countercyclical as a developer. And then we have a very small fraction of the portfolio in smaller juniors that are not so much sticking holes in the ground looking for gold, but they're trying to prove out assets that are at some sense already economic. Okay.
All right. So it's a spectrum, and you outlined your time horizon, 5 years-ish. Stretching for 10 when it makes sense. So obviously, that's a long commitment. As you said, you partner with these companies when you write a check. Sean, talk to me about how you dismiss companies quickly, right? Because obviously you're looking at hundreds of opportunities, right? And a challenge you must face is getting rid of the obvious no's as fast as possible so you can spend more time on the possible yeses. Does that make sense?
Yeah.
So do you have ground rules for quick dismissal of companies that aren't worth your attention?
So the easiest way to kind of winnow down the list is the governance issues. So you have a number of companies in the space, and the space is really famous for insiders that are more interested in profiting from either their recurring fees or their director fees or their comp or their options, which then they liquidate when they get them, and then perennially coming back and trying to sell stock to New Yorkers rather than actually profit from the successful exploitation of a particular asset that they're able to discover or buy. Right. So I would say that for us is the single largest disqualifier.
And how do you go about for someone who's not familiar with determining governance issues, Sean, are you looking at the people and their track records? How are you going about finding those red flags?
So all the people, we're going to have track records, and you're not so much interested in what they say they're going to do. You're interested in what they've done for the last 20 years. You pray that people change and become better actors, but it's just not something we invest around. So, you can really see a pattern of behavior. How have they allocated capital on the board they're on? How have they allocated capital on the other boards they're on? What people in the industry are they associated with? How do those people behave? How do they finance their assets? How do they incentivize themselves and other insiders? Do they actually own any stock they actually bought with their own money? These are not particularly sophisticated or nuanced things, but I think given the very short time horizon a lot of investors have in the space, it's not something we see done that often. The other thing that we've really tried to understand is trying to get a better sense in terms of those boardroom dynamics. How are the decisions being made? What are the range of strategic issues that board's considering? Is that a board that was built by the CEO and is really beholden to him? Or is that a board that actually has some independence and has an independent set of opinions and wants to has a vision for the company that is in any way balances out a vision that the CEO may have? And how healthy is that dynamic? And oftentimes in the industry, the answer is really not that healthy.
Right. And that's because the board is really constructed by the CEO to serve the CEO's interests. Is that getting back to that?
So that's a problem. You also have boards that were built serially where you have the geologist that discovered the assets on the board, and then one of the companies that was bought years ago is on the board. And now you've had a lot of turnover in the board as certainly the Canadian and Australian listed companies are checking boxes for ESG, so they're checking boxes in terms of diversity, they're checking boxes in terms of other types of representation they want on their board. And so you can get some boards that have had a lot of turnover, may look very good on paper, check a lot of boxes on paper, but really don't have representative of shareholders at the table, so to speak. And if the directors and the C-suite don't own a lot of stock themselves and aren't really going to be compensated through the returns of the shares instead of perpetuating and growing the company, you can have a real agency issue in the space that can be just insoluble. And so we're not in the business of going in and fixing these companies. There's instances we'll engage with the board, we'll engage with management, we'll make our opinions known. I think in some cases we have been helpful in helping companies onto kind of sounder footing from a governance perspective, but we're not out there looking to pick fights and find people that are misaligned that we can throw out and change the board. That's just not our business.
Yeah, that makes sense. Okay, so step one, or an important step, I don't know if it's your step one, but is governance issues. We do this by analyzing the people, who's on the board, what's their track record, who are they associated with, their community, all this stuff, trying to find bad actors, and we eliminate those opportunities. On the other side of that conversation, do you have personality, Sean, like the Ross Beatties of the industry, but maybe some lesser known names that you think, whatever they do, I'm invested because, I just trust their judgment. They've put the puck in the net 2 or 3 times, and I know this is a winner, and they're probably going to be a winner for their entire career. If I do nothing else but follow them around, I'm probably going to do all right. Do any names come to mind?
The obvious one I think would be, the Endeavor again. So there you've had great alignment. Yeah. I think if you look at the governance changes at MAG, we've been very encouraged by that. Peter Barnes has a great long-term track record. George has done a great job there. They've been very transparent and really a nice change from where they were 10 years ago in terms of using their cornerstone asset to finance other geological theories that they had on other properties, to really seeing the uniqueness of that world-class asset they have in the Juanicipio joint venture, and then husbanding that and shepherding that asset through to production, but doing it with as little dilution as possible. And that was a big change for us there. And I think it's been a great story over the last 10 years in terms of governance, board dynamics. That's a board that I think has gotten a lot better over the last 10 years. So it's not a direct answer to your question in terms of one person, but that's a dynamic that we've really, I think, benefited from and we're very encouraged by.
Okay. No, I'll take that. That's a great example of that in play. Now, when it comes to jurisdiction, how cautious are you? Do you have absolutely no fly zones? I've seen a trend from investors in the gold space become far more worried about geopolitical risk than they were 5 years ago, right? I've seen that trend just in the conversations I have. But talk to me about your personal perspective. Does that apply?
So we have some geographies where we're just not interested, like a lot of investors are not interested. I think, there's the obvious from, Venezuela to the almost all equally obvious to Argentina, where it's just like, life's too short. It's not clear that's going to fly at all. I think generally speaking, over the last 5 years, been very disappointed by what we've seen in Latin America from a jurisdictional perspective, and really pretty encouraged by what we've seen in West Africa. So, Escobal is probably the poster child for all of this silver asset in southern Guatemala. $2+ billion ounces of $2+ billion worth of silver. The mine's built. It's an underground mine. There aren't environmental issues associated with the mine, and this has been shut down by the government of Guatemala now for 3+ years. And that's a product of some very aggressive NGO activity and I think a very politicized judiciary in Guatemala. That's kind of been beyond the reach actually of the president and the political class, certainly currently in Guatemala, which is a level of complexity and pushback on an asset that doesn't really have environmental issues at all that you just don't see in West Africa. Now, West Africa, you have the issues of you have some people with guns in the Sahel that come down and are creating trouble in a number of these countries, but where that line is. You can have a sense in terms of what the bounds of that are, and the projects aren't going to be randomly stopped that are kind of out of the in safer jurisdictions in West Africa. And so that we found more predictable, easier to get projects built on time, on budget than really anywhere else.
Interesting. Okay, that's great to hear. Now, so would you consider that an emerging market in your portfolio, like a frontier market, or is this a place that's a bit more tried and tested?
Well, West Africa, I think it's certainly going to be a frontier market by everybody's categorization. But I think that's kind of the opportunity where you have the perception and the reality are a little different. So, the perception of West Africa is, I think from an American perspective, is generally horrible, sure, right? And I think people generally have a very modest amount of knowledge about what's going on there. But the idea that Bristow was able to build Randgold in West Africa, create all that value, merge it with Barrick, that you have now, Endeavor's is probably the next best example of a 1 million+ ounce producer that, had its origins in West Africa. You just don't see that in other parts of the world. So it's been an enormous amount of value creation there. And contrast that with, Peru, right? So here's a, mining country that has these great endowments of mineral reserves that people have exploited for decades, that was seen as an attractive place to work, that now has had, they've overlaid a political crisis on what has been ongoing, provincial governance issues for years. And it's become a very difficult place to work and get permitted. So there's a lot of nuance in that, but I think it's generally different than what the markets are able to discount just from a 30,000-foot view.
Right. Okay. Now at Equinox, do you or your team, like how frequently do you need boots on the ground, Sean, before you make that call? This is a good idea or it's not. Do you have you sending people to West Africa or wherever you're going? How important is having to taste the dirt, so to speak, for you and your team?
Yeah, so you got to go. COVID's been, a struggle. So it's been a struggle to go in the last year and a half. I've been to West Africa. Our team's been to West Africa. You got to go see the assets. You have to have some appreciation for what it's like to work in that environment, right? How difficult, how undesirable. One of the nice things about West Africa is it's a pretty undesirable place for NGOs to locate. And so they don't want to set up shop right down the street from your mine and sit there all day long and figure out how to, poke holes in whatever you're doing, which is just not generally the case in what we see in a lot of Latin America. I think the topography has a lot to do with some of the permitting success, right? If it's kind of a flat red dirt for here and, 100 miles in every direction and, 50 people have to move, 2 kilometers that way, that's much more possible than moving 50 people in a valley in Peru to the next valley, which is, may just never happen. It's just, and having some sense of that level of issue in terms of whether or not a project is feasible, how many issues there are likely to be in construction and bringing a project online, and what issues you're likely to face. I think it's just you need to have a lot of those parameters lined up in your head before you're able to invest in some of these juniors, and certainly one or the single asset or 2 asset juniors that you might where you're going to see these really big discounts in NAV.
Yeah. Okay. Now, we talked about around 600 million in assets under management, 450 of which allocated to mining precious metals. What's the rest, Sean?
A lot of it's E&P. So we own a number of Canadian E&P companies that were absolutely left for dead in the spring of last year, so the spring of 2000, on the idea that oil and gas were buggy whip, that we were just going to stop using these assets, and that the companies that had these massive investments and certainly any debt to go with those were just not worth much, if anything. And if you look at the OPEC World Outlook report that just came out last month, where they have their projections out to 2045, I think you can see, certainly outside of the OECD, you're going to see population growth, you're going to see energy consumption growth, you're going to see natural gas consumption growth, you're even going to see oil growth out for 20 plus years. And so the idea that these were uninvestable and had no terminal value, I think just isn't true, and the market just was getting the pricing of these assets very wrong.
Are there any analysts or newsletter writers, bloggers, podcasters, YouTubers, I don't care, any sources of content, Sean, that provide, in your opinion, a very pragmatic analysis of the energy sector that you would recommend somebody like me who wants to understand it better would go to?
So there's the energy specialist, Goring, I forget the other guy's name. They do a great job in their quarterly letters, and they'll give a good overview. I do think the OPEC report, it's 300 pages long, even if you just read the highlights. It gives you a really good starting point in terms of assessing, if OPEC's too bullish about hydrocarbon demand over the next 25 years, where do you differ, right? And so you pull up something like that report and then look at a, net zero 2050 report from, environmentally minded provider that really wants to reduce hydrocarbon use globally, and try to make an assessment of how plausible you think, the various scenarios that they're playing out are. And so if you think you can go to a country like Nigeria, where half the people or 40% of the people don't have regular access to electricity, and they have this huge hydrocarbon endowment, and you can tell the Nigerians that, you just can't use your hydrocarbons to provide electricity to your people, but you got to do something else, but we're not going to pay for it. And then you're going to fly out in your private jet and hope that all works. I think that just doesn't sync up with reality or what's going to happen. So I think there's a lot of political bias people in the West are now bringing to the hydrocarbon space that's affecting their ability to look through some of the politics around the space and to make a more reasonable assessment of what the opportunities are.
Okay. Yeah, I appreciate that. Okay. Are you sitting on much cash right now? Like, are you sitting on a lot of dry powder? We talked about, hunting mode right now versus farming, but
yeah, we don't run. We run very modest amounts of leverage in Equinox, and in the other accounts, none at all. So, this is certainly, I think, in these two sectors is a real opportunity. In gold and silver mining, it's certainly a cyclical opportunity where you have a lot of these companies trading at more than 50% discounts to NAV, assuming spot gold prices, and given the macroeconomic and geopolitical backdrop, that's a fantastic entry point. So we don't see any reason to be on the sidelines there. We're fully invested there. And then on the energy, the oil and gas, again, I think that's actually, from a full cycle, like a career cycle in terms of generation, that's a kind of a once in a generation, once in a career kind of investment opportunity that you've had in the last year there. So again, we're not on the sidelines there either. We're fully invested. So not using leverage, I think you're going to have a pullback in equity markets. And I think there's a lot of fragility built into, financial assets writ large right now. So I don't think you want to be overextended. But these are sectors where I think you can be fully invested today.
Okay, now outside of oil and gas, outside of precious metals, are there any exciting contrarian bets that you see right now, Sean?
Well, those are the two. Those are the two big ones.
Yeah.
Look, most financial assets are overvalued. Certainly, that's true almost uniformly across the fixed income world. Equities, popular Western equities are, very fully valued. So I don't see a lot of, and we're even seeing now speculation that's similar to what we saw at the end of the last century, where you have some pretty pedestrian business models that are getting very full valuations, everything from pizza delivery to car washes this is not some super new technology that deserves this very fancy multiple because it's going to change the world. It's still just pizza delivery. So, that I think seems very frothy, and I think is interesting on the short side, not the long side. We still see some good pockets of value in kind of off the run emerging market and frontier markets outside of the energy and gold mining spaces. So, but these are very kind of one-off. So something like, if you're going to go invest in Ghana outside of gold mining, there's actually interesting things to do. If you're going to go invest in Turkey, has some very cheap stocks. Obviously, a lot of political problems in Turkey, a lot of macroeconomic problems compounding those political problems, but some very cheap stocks in Turkey. So there's things to do kind of off the run, off the beaten path, but the more conventional asset classes, even in EM, are not cheap.
Yeah. Okay. Have you built either personally or through Equinox a position in any crypto assets?
No.
Can I ask why?
I think skepticism about the asset class. As a gold investor, certainly understand the appeal of having money that's separate from that's not government created money, right? So that very much resonates with me. But the idea that you want something that's totally dematerialized, that is really separate from nature, that is created by an algorithm, and that's going to be superior to something like gold that has the natural physical limitations to it. I think that's where it kind of lost me. And so, look, obviously people have made an enormous amount of money in that space, but I think it is very much more of a speculative asset class rather than, kind of an acre to windward or something that's going to be an actual hedge when other financial assets struggle, which is, I think, still very much what gold is.
Do you care to speculate at all, Sean, on, I guess, maybe the future of regulation or legality? We looked at what what China's done in the crypto markets recently? Do you care to speculate? Do you care at all? What may happen in the U.S. in the next 5-10 years, looking at these markets?
Yeah, I think that's from a gold investor's perspective, fascinating, right? Because the bloom's kind of off the rose now in terms of what you saw at the end of the Trump administration and what you've now seen in the Biden administration, in that there is just a real antipathy within the bureaucracy, within Treasury, within the CFTC towards this whole asset class. And the idea that they're going to come up with a very abbreviated comment period right before Christmas, and you're going to have to introduce all of these incremental hurdles to trade crypto so that it's compliant with government regulation in a way that I thought seemed pretty aggressive, I think is telling you a lot. And Gensler is telling you this too just now and in his speeches. It's not that they're trying to protect people. I think it's just that they don't want competition of the dollar, which is very similar to what they've done to gold, right? So you can't go open up a gold-denominated account at a bank account. You can't integrate gold into the financial system in a way that wouldn't be excessively punitive from a tax perspective. The whole way in which gold is taxed as a collectible, I think, is just simply intended to discourage use of gold as money. And what's really interesting about the crypto regulation is it's kind of clarified, I think, in everybody's minds that this is, from the U.S. government's perspective, really just a defense of the dollar. And it's not really about the respective merits of gold or crypto. It's about defending the dollar from competition.
Okay. Do you have stock tips, Sean? Not stock tips. Can you share names at Equinox if I'm looking for the earliest stage, highest speculations that have caught your attention?
Earliest stage, highest speculation is not what we do. I would say that there is great money to be made in these juniors and even some larger juniors that are in development or are not tip of tongue amongst generalist investors. So let's see, West African Resources. This is a company that's at half of NAV, has a free cash flow yield of north of 20%, has a great asset in Burkina Faso, good, well-aligned management that brought the asset on time, on budget. It's in the right part of Burkina. There's a lot of boxes there they're checking. Mag Silver is one, and silver, I think, is every bit as interesting, if not more interesting than gold, and that there's going to be highly correlated, but I think there's more leverage to the upside. And Mag is finally bringing on its joint venture Juanicipio project with Fresnillo. And I think that's not only an asset that is a world-class asset, that joint venture property, I think, is very likely to have other world-class assets on it that are, you can see the vein on the Fresnillo side of the border. That vein doesn't just stop because of where the joint venture property starts. And so there's a lot more ounces that I think you can have confidence in that are going to be part of MAG's long-term attributable production that just aren't in the NAV model. So there's a lot more value there that I think the market's giving them credit for at $21 a share. So those are two names that I think are, some reasonable size, are not speculative, but there's a lot of upside to both of those two companies.
I love it. Okay, Sean, look, it's been great getting you on and getting to know you a little bit. It's about time I had you on the show because I've seen a lot of your interviews elsewhere. So thanks for making the time, getting in front of my audience and having this conversation with me. I appreciate it.
Jay, I appreciate it.
Okay, guys, 3 last things. First, if you enjoy my interviews and would like a bit more, you can subscribe to my Friday newsletter. It's free, and the comment to subscribe is right beneath this video in that pinned comment. In this newsletter, I share my key lessons learned, takeaways, and any actions that I might be taking in the market as a consequence of what I've learned on the show. Second, when I started a YouTube channel, I never anticipated generating any advertising revenue. but coincidentally, I do now, which is awesome. And so what I've decided to do is donate this to an organization that is very close to my heart called Zero Ceiling. Their mission is to end youth homelessness. The way they do this is by providing young people experiencing homelessness with supportive housing, employment, professional support, life skills, and outdoor adventure. Because often young people in urban centers with no resources will never get the opportunity to experience wild places, nature that can be so transformational, and absolutely was for me. Third, if you prefer to listen to my content, you can now find us wherever you listen to podcasts. Just search for The Jay Martin Show.